Welcome everybody to today's webinar. Glad to have everybody here. Thanks for taking time to be with us. And today I'm going to talk about a strategy that I kind of started doing. A lot of trades you do out of necessity. Maybe the market conditions change and you're trying to find something to work. But this is a strategy, the combo strategy, that kind of came up with it when the volatilities were higher, maybe in 2020, 2021. And when volatility started coming down, some of these short-term double strategies, you get hurt by volatility a little bit. So this is kind of a combo strategy, kind of takes volatility out of the game. So a neutral, what I like about it, it's a relatively neutral delta, so it's a range-bound trade. You don't really have volatility risk much in this. You have price risk. It's a 8-day trade, but you got a ton of room, and you have good theta. So I'm not normally, if you said to me historically, at least in our community, have we gone a lot of 3, 4 to 8-day trades? No, but I like them. I really like it. Gives you a lot of room, and they work pretty well. That's what I'm going to talk about today, the combo. When I think of the word combo from Chicago, one thing comes in. And if you haven't been from Chicago, you probably haven't seen it, but you go into a place like a Portillo's, a famous lunch spot, and they give you a big Italian Vienna bread, like French bread, slice it in two, but it's still connected, right? And I'll tell you why in a second. So you put on there the Italian sausage, you put on there the Italian beef over it, and then you drizzle some odd juice over it. That's why you want the bread connected. Then you put sweet peppers on top, hot peppers on top. I mean, if you want cheese, you could do that too, cheese, but I don't do it. And that would be a combo. So I'd say you go in there and say, give me a combo, juicy, hot and sweet peppers. So not that it has anything to do with this seminar, but that's the combo that I'm thinking of. But let's run in and actually look at this trade. So here's one that I'm profiling here. I don't know what you would say this would look like maybe a sleek airplane or something. This is the cheapest version of it. And if you look at it, I'll get to the Greeks in a second. Here's the Greeks. But as far as the setup, and this is one, again, we'll talk about various strategies on the weekly webinar, but I think it's good to practice them on paper, get used to them. So here's the setup. So you can look at today. March 15 is my expiration, and March 15 is 9 days from today. March 15 is a week from Friday. With me? So what I'm doing is, and again, things change a little bit as the VIX changes, but for the most part, let's see, VIX were at 14.5, kind of in the middle of the range on the VIX level this year, right? The last 2 months and a week, we've been between like 12.5 and 16. So what I'm doing is if I start here, we're at 51.09, near 51.10, and I'm going up about 40 points. And I'm going to do a 25 wide butterfly in the calls. And this is the cheapest version of doing one. So I'm doing a 25 wide butterfly. I place my short up 40 points from the current price at 51.50. And this is 25 wide. Right? And this component, this butterfly piece, you would say, I'm doing it, if this is where the underlying is 51.10, I'm doing a directional or bullish call butterfly. I'm a little bit long. I'm a little bit long deltas. Here's my gamma, positive theta, and short vega. That's part A. Part B is go 40 points down and add a calendar, right? Go 40 points down from where we're at. You're going to get a little bit short delta, positive theta, long vega, and you have a calendar. When you combine them, again, we're around 5110. We have the butterfly short strike at 5150. And the calendar strike at 5070. I don't know if this looks like one of those state-of-the-art cars. It looks like one of these sleek cars. I don't know what it looks like. But it's down here in the middle, which is fine. It's not under zero. And so you have plenty of room. Now, the cost of this trade, this is the cheapest version of this. This would be about $400. So you can do a range-bound trade in SPX for $400 on a $5,100 vehicle. You're bringing in positive theta, right? In a calendar, you get positive theta because your shorts decay quicker than your longs because they're a shorter duration. In the butterfly, you have positive theta also because your two 5150s will decay quicker than these. So you have positive theta of almost $60. Well, if you took your positive theta of $60 divided by 400, 60 divided by 400, that's about theoretical P&L per day, right? This is a theoretical theta. So you're getting almost 15% a day, right? Now, you say, Dan, if I could get 15% in a day, that's a theoretical number. But because you're combining a long vega calendar and a short vega butterfly, your vega, your volatility exposure is much lower than if you did like a double calendar or something like that. Now, why? And I would either do this on a Monday that expires Friday, right? Or I would do this on, like a day like today, a Wednesday, and it expires a week from Friday. So this is as we said, this is a 9-day trade. Now, why does this work pretty well? Why do you think? Why do you think this works pretty well? You got a lot of room, right? If you said to me, probably, if I put this on Wednesday, when would I expect to be out of this move, out of this trade? So this is what did we say, a 9-day trade. I expect to be out of this at the latest, probably Monday. Could be Friday, but Monday would be more realistic. So if I look at Monday is March 11th. And Monday, the expected move on Monday, 5 days. So this is a 9-day trade. Expect to be out of it by Monday. The expected move, they're saying there's a 68% probability on Monday's date that we'd be up or down 62 points from where we're at. So make it 60. But so if we're around 5,100 now, I'm just making it easier math for myself. There's a 68% probability by Monday will be between, by the end of the day, Monday will be between, excuse me, 50, 40, and 5160. They're saying that one standard deviation, 68% probability from now through Monday will be between here and here. Well, how does that fit with what we have on? If you look at this, here's 50, 40. And if you look at this, here's 5160. And there's about a 68% probability we'll be between here. And if I run this on Monday's date, this trade, you can see here, this purple line would be your potential profit on Monday. And this is only a $400 trade. I think these yields are a little, potential is high, but you can see it looks pretty good, right? So without any adjustments, without any risk management, because of the room you're getting, because of the amount of time I'm looking to be in the trade and the expected move, I think this is a very high win rate. I would say the win rate on this could be 75, easily 75%. Now, do we have to, when you're doing any short-term trade, do you have to be aware of news events, potential landmines, potential gap moves, right? And this week we have, I believe, Thursday morning, tomorrow, forget the news in the morning, and then Friday, I think, as Bob is mentioning, we have the Friday we have the what's that, the non-farm payroll. And so those are potential that could have a bit of a gap in the morning. But what's nice is with these trades, if you put them on like right here in the middle, what's this, 50? Now we're closer. Looks like we're definitely backing off in the SPX, isn't it? You know, I'll tell you, I'll give you my thoughts. How many, for range-bound traders, the last 2 weeks, you know, you look at a price chart of SPX and you say, you know what? 1 second here. You look at SPX and you say, well, Dan, is kind of range-bound the last 2 weeks in the market. Good for range-bound traders. Yeah, I mean, you kind of want that, but when you look at quite a few of these candles here, when they get a little bit bigger, it doesn't, maybe I have too long of a horizon here, but we've had some 50, 60 point ranges in SPX. So, you know, when you look at between yesterday's low and today's high, what was that, 60, 70 points? Maybe more, right? If we just, I mean, to give you an idea, so for a range-bound trader, yeah, these swings are causing you to adjust a little more. If you look at yesterday as March 5th, we hit a low of 50.56. The high today is 51.28. So you're talking 44, 54, 64, over 70 points. Do you agree? Over 70 points in SPX from the low yesterday to the high today. So that can cause you to do a little more adjustment. So I would describe as a range-bound trader the last 2 weeks extremely whippy, right? Extremely whippy. And so anyways, so this type of trade overall, I might have to redo this, 5,100 So let's bring everything down 10 points, and let's bring this down. We're at 5,100 now, so I just evened it out a little bit. But does everybody see this? So this would be a combo, a lot of room, but again, we're looking to be in these trades 2 to 3 days. And again, you're aware of news. You're trying to do that, but when you're in the middle here, you've got 40 points either way. There's many different ways to adjust these. When I start getting into 4 to 8 days from expiration, I don't like to because your price risk really picks up under 8 days. So I don't like to do a lot of adjustments. But typically what we do, and then I'll give you a few more thoughts. If we go up, depending on how quick we go up, but if we go up maybe 10 points past the short strike here, I would just take off the put side. Right? So if we go up 10 points past the short strike, take off the call side. Excuse me. On the upside, if we go on the butterfly, if we go 10 points past the short strike, take off the calendar. If we're going down and we go 10 points past the short strike of the calendar, take off the upside butterfly, right? I don't like to do personally more than one adjustment for these things. When you're only talking 8 days, I mean, you could do 2, but generally 1 is all you need. So I think it's an easy trade to manage. And if you want to put a little more capital to it, instead of being 3 wide between the long and the short in the calendar, if I go 4 wide, now I'm up to 370, and then take the butterfly from 25 wide to 30 wide. And then now you're instead of a $400 or $500 trade, you're at a $700 trade. I think Josh was saying, if we've been going back and forth, why is the VIX low? What's it going to take? VIX is not a good measurement of volatility on the upside, right? VIX is not a good necessarily a measurement of a whippy market. If VIX goes to 18 or 19, it's telling you one thing. If we go to 18 and 19 VIX tomorrow, it's absolutely telling us one thing. What is it telling us in SPX? If VIX goes to 18 or 19 tomorrow, what is it telling us? It's telling us that the market's getting hammered, right? But in terms of, if you look at a price chart of SPX and you see, in the last 4.5 months in the market, we've gone up over 25% in the SPX. We've had some speed on the upside, right? But you can see here, ATR is more of a measurement that can pick up speed, and we've been going up, right? ATR, average true range, is looking at some of these big candle days, right? So, but VIX is not a good measurement of how volatile the market is on the upside. If you want to look at volatility on the upside, look at ATR, look at the size of the candles, that type of things. So any questions on managing this type of a trade? Yeah, Josh, right. VIX is mostly a measure of fear, especially the downside. But I think, we've been doing this type of trade in the community for, I don't know, maybe a year and a half. I don't know if there's anybody in here in the community that would, but again, it takes your volatility risk very low, very good theta. You get out of the trade generally on these 8-day trades, 2 to 3 business days at the most. And if you're doing a 4-day trade, a 4-day trade would be putting it on Monday. Like right now, this trade is a 9-day trade. But if I put this trade on Monday, would everybody agree? The same trade, expiration, everything, it would be a 4-day trade, right? So 4 or 8 days. Now, again, couple principles. When you're doing a 4 to 8 day trade as a rough example, I would use minimum 50% less capital than you do when you're using 20 to 30 to 40 to 50 day range bound trades. Is that clear? When you're doing, because of the price risk, when you're doing 4 to 8 day trades or 3-day trades, use minimum 40 to 50% less capital, right? So if this trade were, $700, if I was doing a 30-day trade, whatever the range bound trade, butterfly, iron condor, it could be 15, 16, 1700. So number one, you're using less capital. So some principles trading short-term trades. Number one, use 40 to 50% of your capital on a 30-day trade or whatever. Principle number two, the shorter the duration, less adjustments I'm going to do, and I'm not going to increase my capital in the trade because you're delving into price risk territory under 10 days. So I like adjustments that reduce the risk of the trade. So as we go up, I'm taking off the put side. As we go down, I'm taking off the call side. Bob says, it doesn't matter, Bob. I'd say be consistent. He's saying, do you want to do March 15 weeklies or monthlies? I mean, I'm used to doing weeklies, but I think whatever, if you're just consistent with something, I think that would be good. The other thing you can do, what if you want more punch? How many people would say, Dan, over the next 2-3 days between now and Monday, the days for this trade, how many would say, Dan, I think we'll be closer to the short strike of the put side or the call side? In other words, how many think we'll be down closer towards 50, 60, right? We're at about 5,100 now. How many think we'll be closer to the short strike on the upside, 5,140? You could just say up or down. And let's just take the down for a second. So let's say you said, Dan, I think there's a better chance we'll be on the downside. Well, one way to tweak this a little bit is to get more oomph, more height on the curve on the downside. If I think there's more of a chance to go to that 50, 60, so here's what I'm going to do. I'm going to narrow the call side. Oh, no, I'll leave the call side alone. I'm 30 wide. You with me? So that's 360, similar of the calls. But I'll narrow this to 3 wide, right? And I'll do 2 contracts. So it's still about the same capital on the calendar as this, right? But now you see I've got if we do go down on this downside, right? Look at that, the 10's bigger, there's more potential down here. If you said to me, hey, Dan, I think there's more shot for the upside, then I'd go back to how this was, 4 wide, and I want to enlarge this a little bit. How would I do it? Instead of 30 wide, make it 20 wide and do 2 of them. You see that? So then it kind of makes it bigger. So there's different ways you can tweak these things. I'll put it back up to where it where it was here. But I think, the bottom line is, if you want to get any strategy, today we're talking combo. If you want to get any strategy in your bloodstream and start becoming a craftsman, commit to doing, whether on paper or live, 10 of them, right? Because you're not, let's face it, you see a recipe you see on a cook show last night, you're not going to be any good at any of this stuff unless you do it 10 times, right? I mean, that's the answer. So anyways, any final comments or thoughts or anything on this type of trade? Now, if I was going to put this on tonight, because you have, or let's say I was going to put on tonight or Thursday, because I'm aware there could be a potential gap in the morning, I mean, I might wait till the last hour just so I'm more centered, right? That I can handle the move. But yes, you want to be aware of news events and stuff. So anyways, Bob, I might have to, Bob, you've had some good stuff here. Do me a favor, Bob, send me those as far as what you wanted me to review or something. Oh, you're just saying that's more managed by the group. Send me those, I'll answer. Let me just say one last thing for those who might be interested. I just did, hot off the press I did a 3-hour managed by the Greeks class on Saturday. I think that, just like, as I say, just like the instrument panel in a cockpit, you've got to understand how the various Greeks affect your trades and everything. And so it's on our website if you go to the front page. But this Friday at 2 Eastern, I'm going to be adding a supplementary kind of a managed by the Greeks live demo, how to do it in live prices and everything. And so for those who will get the class, should be part of that demo on Friday. I think the class is $297, so give you 3 hours on the recorded or the class I did. I think I did about 27 slides. I think it'll be a very good foundation I think you need. And really what managed by the Greeks is risk management. And I think that's an important skill. So you could check that out on the front page. Johnny put a link in here if you're interested. But the live demo will be going on Friday at 2 Eastern. So again, if you have any questions on today's chat on the combo or the class Friday, send me an email. Good luck trading in this whipsaw week. Next week, I might do the next webinar. I'm just thinking of what do you, just like any challenge in life or challenge in the markets, what do you learn from it, right? And what are some, we've been talking about in our community, what are some principles that you can learn from managed by the Greeks and how to avoid getting whipsawed? And I might address that at next week's webinar. So have a wonderful weekend, everybody. Thanks for joining us, and I'll see you next time. Thank you.